So what I wanted to start today is talking about insurance, starting with the concept of insurance. And then I wanted to reiterate a theme of this course, that financial institutions are inventions. They're structures that someone had to design and make work right. Sometimes they don't work right. Then I wanted to move to a particular example of insurance, which was, until recently, the biggest insurance company in the world, called the American International Group, or AIG. And it's particularly important that we talk about this example, because on March 2 we have the former CEO of AIG, Maurice Hank Greenberg, coming to our class. So I thought it's appropriate that we use AIG. Well, not only because it was the biggest insurance company in the world, but also because he's coming here. So the fundamental concept, again, is risk pooling. The idea of insurance goes back to ancient Rome, but only in very limited forms. But the idea of risk pooling is kind of an obvious one. People form organizations partly to risk pool. So in ancient Rome, a common form of insurance was death insurance that would pay funeral bills. And people in the ancient world believed that you had to get a proper burial or your soul would wander forever. So insurance salespeople associated with guilds or business organizations would sell funeral insurance. But they didn't have a very clear idea of the risk pooling concepts. It must have underlain their thinking. But it wasn't until much later that people began to understand the concept. There were examples of insurance throughout ancient and medieval times, but they're very blurred and sparse. I remember reading supposedly an insurance contract written in Renaissance Italy, translated into English, but it was hardly recognizable to me as an insurance contract. They didn't have the concepts down. It seemed to have a lot of religious language in it, which normally we don't think of as something that's part of an insurance contract. But it seemed like insurance came in the 1600s, at the same time that certain concepts of mathematics began to be developed. Notably, the concept of probability became more widely known in the 1600s. According to one historian, the oldest known description of the insurance concept goes back to Count Oldenburg. Actually, it's an anonymous letter to Count Oldenburg written in 1609. And the letter says, why don't we start, I'm paraphrasing at the moment, why don't we start a fund in which people pay 1% of the value of their home every year into the fund, and then we will use the fund to replace the house if there's a fire. And now, quoting this anonymous writer, this writer said he had no doubt that it would be fully proved if a calculation were made of the number of houses consumed by fire within a certain space in the course of 30 years, that the loss would not amount by a good deal to the sum that would be collected in that time. Okay? It was just intuitive. He said, there can't be that many fires. And if we collect that amount of money every year, we can pay for all the houses that are burned down. And so he didn't express any mathematical law, but it's the concept of insurance. You don't find that before 1609. So I guess we don't have any clear statement of insurance before then. Actually, you can find approximate statement of the law of large numbers. And I'm thinking of Aristotle, the philosopher. He wrote this is in ancient times, and I'm quoting from De Caelo, his book, Aristotle, to succeed in many things or many times is difficult. For instance, to repeat the same throw 10,000 times with the dice would be impossible, whereas to make it once or twice is comparatively easy. See, he doesn't have the language of probability, but he knows you can't throw the dice 1,000 times and come up with the same number every time. Now we have a probability theory about it. So we know that if you have n events, each occurring with a probability of p, then the average proportion out of the n events that occur, you have n trials, an event occurring with probability p, then the standard deviation of the proportion of events that occur is p times 1 minus p all over n to the 1/2 power. And that's a theorem from probability theory. The standard deviation of the proportion of trials for which the event occurred, assuming independence, is given by this. And so you note that it goes down with n. As n increases, it goes down with, the square root of n. So that means that if n gets very large, if you write a lot of policies, then the probability of deviating from the mean by more than 1 or 2 standard deviations becomes very small, which is what Aristotle said. But making insurance work as a institution to actually protect people against risk is rather difficult to achieve, and that's because things have to be done right. So let me just remind you, what are the basic types of insurance? This is what Fabozzi talks about. There's life insurance that insures people against early death. Of course, you still die. What it really insures is your family against the loss of a breadwinner, the father or the mother. So life insurance is suitably given to families, especially with young children, to protect the children. It's very important. It used to be very important when there was a lot more early deaths. Now very few young people lose their parents, so life insurance has receded in importance. Another example is health insurance. This is insurance, of course, that you get sick and you need medical care. Then there's property and casualty insurance, insuring your house or your car. And then there's other kinds of, you might call it investment-oriented products, like annuities. This is a table in your textbook by Fabozzi, which lists these categories of insurance. But any of these insurance types are inventions, and I want to specify that we have the idea that an insurance company could be set up that would, say, insure houses against fires. And we just heard it intuitively in this letter to Oldenburg long ago. But to make it work, and to make it work reliably, involves a lot of detail. So it's like, you can think of the idea of making an airplane, but to make it really work and to make it work safely is another matter. So first of all, insurance needs a contract design that specifies risks and excludes risks that are inappropriate. An issue that insurance companies reach is moral hazard. Something rubbing when I... Okay, I'll try not to... Wait, what's doing it? It's this one. Oh, okay. Moral hazard is an expression that appeared in the 19th century to refer to the effects of insurance on people's behavior that are undesirable. So the classic example is you take out fire insurance on your house, and then you burn it down deliberately in order to collect on the house. Or another example is you take out life insurance, and then you kill yourself to support your family. These are undesirable outcomes. And they could be fatal to the whole concept of insurance, because if you don't control moral hazard, obviously the whole thing is not going to work. So what they do in an insurance contract is they exclude risks that are particularly vulnerable to moral hazard. And so that means you would exclude certain causes of death that might look like suicide. You can do other things to control moral hazard than excluding certain causes. You can also make sure that you don't insure the house for more than it's worth, right? If someone insures a house, and the insurance does not cover the full value of the house, then there's no incentive to burn it down. You might as well just sell the house, right? No point in burning it down if you'll still lose a little bit of money. So that's one of the problems that insurance companies face, and part of the design of the insurance contract has to prevent moral hazard from becoming excessive. An analogous thing is selection bias. That occurs when chalk keeps breaking. Selection bias occurs when the people who sign up for your contract know that they are higher risk, and so that they then want to, for example, health. People who know they have a terminal disease and are about to die, they'll all come signing up for your life insurance contract. That will put immense costs on the insurance company, and if they don't control the selection bias, they will have to charge very high premiums, and that will force other people who don't know they're going to die out of the business. So out of buying insurance. And so that's a fundamental problem. That again, something has to be done to define the policy. So one thing you can do is exclude in life insurance certain causes of death that are likely to be known. And you only put on causes of death that people wouldn't be able to predict about themselves. Okay. Another aspect of insurance is that you have to have definitions of the very specific, precise definitions of the loss and what constitutes proof of the insured loss. If you're not clear about that, there's going to be ambiguities later, which will involve legal wrangling and dissatisfaction. We'll see in a minute that these problems are not minor, and they keep coming up. That's a constant challenge for the insurance industry. Then we need a mathematical model of risk pooling. Well, I just wrote one down here, but it might be more complicated in some circumstances. This is assuming independence. And that's, if you don't assume independence, you can make more complicated models. And then fourth, you need a collection of statistics on risks, and you need to evaluate the quality of those statistics. So, for example, in the 1600s, the people started collecting mortality tables for the first time. There was no data on ages at death. It began in the 1600s because people were building an insurance industry, and they needed to know those things. Then you need a form for the company. What is the insurance company? Who owns it? It could be a corporate form. There are shareholders who are investing in the company, and they're taking the risk that some of our policy modeling, our handling of moral hazard or selection bias wasn't right. Some insurance companies are mutual rather than share. The insurance is run for the benefit of the policyholders, and they're like a nonprofit in the sense that the founders of the company pay themselves salaries, but the benefits go entirely to the policyholders. Then you need a government design so that the government verifies all of these things about the insurance company. The problem with insurance is that people will pay in for many, many years before they ever collect. Right, well, especially if you're buying life insurance, you hope never to collect. And so you don't know whether it's going to work right. That's why you need government regulation. You need government insurance regulators. And that's part of the design of insurance. It doesn't work if you don't have the regulators, because you wouldn't trust the insurance company. So these are problems that have inhibited making insurance work. I wanted to give you an example. Let me start. I think it makes it more concrete if we start out with talking about a particular example. And I said I was going to talk about AIG. It's a very important example, not only because it was the biggest insurance company, it was also the biggest bailout in the entire subprime or financial crisis we've seen now. So AIG, it's an interesting story. It was founded in 1919 in Shanghai. And you wonder, why is it called American International Group if it's founded in Shanghai? It was founded in Shanghai, called American Asiatic Underwriters. And it was founded by Cornelius van der Star. Who is an American who just decided to go to Asia and start an insurance business. Shanghai in 1919 was a world city. It was not really under the Chinese government. It was something like Hong Kong. It had constituencies representing many different countries. And so it was a very lively business center. It's kind of interesting that the biggest insurance company in the world emerged from Shanghai, and also one of the biggest banks in the world, HSBC. You know what HSBC means? They don't emphasize it anymore. It's Hong Kong and Shanghai Bank Corporation. So AIG was founded by Mr. Starr in 1919 and started doing an insurance business in China and moved their headquarters to New York just before Chairman Mao took over China. And then it became a kind of a Chinese investment company in the United States. Cornelius van der Star ran the company from 1919 until he died in 1968. So he was CEO for 49 years, a half century. And then just before he died, he appointed Hank Greenberg, who will visit us, as the CEO in 1962. So that was 49 years under Starr, and then Greenberg took on and then ran the company until 2005. So it was 37 years under Greenberg. So two men ran the company for almost a century. Since 2005, Greenberg has been succeeded by 3 CEOs. The usual thing. The usual company turns over CEOs. The real problem occurred with AIG after Greenberg left. So Greenberg left in 2005, and then the company absolutely blew up, and it absolutely had to be bailed out. And the reason it had to be bailed out was it was primarily almost entirely due to a failure of the independence assumption, I would say, that under their risk modeling. Namely, the company became exposed to real estate risk. And the idea that their risk modelers had was that it doesn't matter that we take on risk that home prices might fall, because they can never fall everywhere. They can fall in one city, but it won't matter to us. That's just one city, and it all averages out. But what actually happened after Greenberg left was the company took huge exposures toward real estate risk, and it fell everywhere. Home prices fell everywhere. Just exactly what they thought couldn't happen. So the company was writing credit default swaps, which are, I told you about those before. They were taking the risk. They were insuring, basically, against defaults on companies whose credit depended on the real estate market. They were also investing directly in real estate security, in mortgage-backed securities that depended on the real estate market for their success. And when all this failed at once, the AIG was about to fail. That meant that the federal government decided in 2008 to bail out AIG. And the total bailout bill, well, the total amount committed by the U.S. federal government was $182 billion. It didn't all actually get spent. It was $182 billion committed to bail out AIG. That's a lot of money. I think that's the biggest bailout anywhere at any time. A lot of people are angry about this. Part of this bailout came from what we called TARP. This is the Troubled Asset Relief Program, which was created under the Bush administration. And it was the proposal of Treasury Secretary Henry Paulson. And it was initially run by Paulson. But it was not just TARP. There was also loans from the Federal Reserve. It was a complicated string of things that were done to bail out AIG. So why did they do that? Why did the government bail out this insurance company? The main reason why they did so was their concern about systemic risk. It wasn't, I'll come back to other kinds of bailouts of insurance companies, but the problem was that AIG, if it went under, all kinds of things would go wrong. All kinds of things would go wrong. All these insurance policies that it wrote on people's casualties, their travel insurance, any of these policies would all now be subject to failure, because people who had these insurance would find that the company that they bought it through was disappearing. But it would go on even beyond that. Lots of other companies, investment companies, banks, would fail too, or may fail too, because they're involved in some kind of business dealings with AIG, which would now become part of the AIG bankruptcy. If AIG failed, anybody who had any business with AIG would be starting to wonder, what's this going to mean to me? AIG owes me money, or what's going to happen? And so there was a worry that it would destroy the whole financial system. This was big enough to cause everybody to pull back. And if everybody pulls back, then the business world stops. It would be like a stampede for the exits. Everyone hears AIG goes under, and so many people do business with AIG. They decided it was intolerable. And so the government came up with the money massively and quickly. If you remember the story, Henry Paulson, who was Treasury Secretary, first went to Congress asking for a blank check. He didn't say to bail out AIG, but that's what he did. He got sort of a blank check from Congress because the story was told, Paulson told the story that if we don't do this, if we let a company, he didn't say AIG, he actually asked for the TARP money before the AIG bailout. But he said, if we don't do something to prevent a collapse, we could have the Great Depression again. And so nobody liked to hear that, but they believed him, and they didn't know what else to do. And so they allowed the TARP money, and they allowed the Federal Reserve and to bail out this company.